Welcome to Oregon Cash Flow Pro. My name is James Barber. As always, I'm here to help you maximize your cash flow. Appreciate you joining us today. Today is Tuesday. That means IUL. We're going to go over some type of an IUL, either do an illustration or review one. Today we have a Penn Mutual IUL to review, and a client sent this in. They sent in a couple of whole life policies that we reviewed last Thursday. Thursdays are our whole life review days. Although this coming Thursday, we're not going to be going live. I'm going to be out of town at a convention. So we will be back next week on Tuesday for IULs again, and then the following Thursday for whole life. So if you have a whole life question, if you have a whole life policy you want reviewed, if you have a whole life illustration you would like reviewed, feel free to send that in. If you want me to review it live. Otherwise, you're welcome to schedule a one-on-one meeting with me via Zoom, and we can go over it together. That will not get shared with the public. We don't do that unless somebody approves of that and gives us their okay to do that. So you can schedule a meeting with me right there, calendly.com/cashflowpro. I'm happy to meet with you at any time. There are a number of free meeting options, some free consultation options. Even if you're never planning on doing any business with me, you're still welcome to sign up. There's a 20-minute free consultation right there that you can sign up for. I offer one of those to anybody for any reason, whatever you want to talk about. That time is yours to pick my brain. So let's jump into this illustration we're going to look at today. This is the Mutual Accumulator Builder Select. Now there's going to be different names throughout the years. This one was issued in 2018. There's going to be different names throughout the years of the different products. They'll change based on rules changes, legal changes, bonus options possibly changing, or MEC limits changing. There's all kinds of things that can happen year to year that lead to revisions in products, and you'll see different names. So this one is in 2018. There's still a lot of the same underlying things that happen in this product in comparison to the current product. So there's things that we can learn. But one of the things that I like to know is what is actually happening in products that people have purchased. How were they designed? Has it been effective? Has it met their expectations? Those are all things that I think are important, not just to me, but to you, the viewer, as well, whether you're an agent or a client that owns one of these types of policies. So let's scroll down through here. The Penn Mutual one, you get the accelerated death benefit, chronic illness, and terminal illness. Overloan protection rider, of course. We always want one of those. This is a 41-year-old male, standard non-tobacco. When they signed up for this, these were your index options at the time. 1 year S&P 500. This is a 1 year point-to-point. And they had a variety of allocations here. So you can see 20% in 5 different allocations. And you can see the rates that were allowed to illustrate at that time. Nice high fixed account rate, 4%. You don't see that too often these days from many carriers. There are some, like Allianz, at 5% for their fixed, and F&G is right around 5% for their fixed. But most of our other carriers are in the 2.5% range. So this is a nice place to start out. We'll be taking a look. What is the current rate right now? Their fixed account right now is 3.25%. So the fixed account has come down a bit since then. Okay. We're going to want to look in this and see what the cap rates were, because this was one of the client's concerns, why they sent this to me, was overall they thought that this policy was slightly overperforming the original expectation, the original illustration, which this is the original. And their main concern was the reduced caps that have been happening. So since 2018, cap rates have come down a bit. That's generally what happens in a lower interest rate environment, which we've been experiencing for the last decade. Those are starting to change. Obviously interest rates started to climb aggressively last year, and insurance companies are taking advantage of that. So we have seen rates start to climb. How much more they'll go up, Who knows? But here's their illustrated rates. The current illustrated rates. I wonder if I can see that quickly here. They're in the 5% range. They're under 6% for sure. Just trying to look at I'm looking at Penn Mutual's website. I'm trying to figure out if they have anything that I can access pretty quickly that shows me what the current illustrated rates are. And I'm not seeing it. Let me see if I have it here. Hey, Gil, how you doing? Sound coming through okay? Let me know if you have any problems hearing me. I didn't double check it today. I'm assuming everything's working okay. So current cap rates are 9% for the S&P 500. That's this one. There's an uncapped one-year S&P. This one has a spread, a 3% spread. It still has a 3% spread. The cap rate is 12%. There's a one-year uncapped with a 1% floor. And that one comes with a 41% participation rate. Oh, that's this one. This one's the uncapped. Okay, so this one doesn't have the capped 1 year that's available with a 3% spread. This one doesn't have that. This one has a high participation rate, which is not showing on the current IUL. So we don't see a high participation rate one. Capped 1 year, 0% floor. Global SPI does not look like that's available either. This S&P Global BMI. So this was available on this one. Does not look like it's available on current Penn Mutual illustrations. They're offering an uncapped 2 year, an uncapped 1 year. These carry different participation rates. And then some capped 1 years. So a little bit different offering than what you see here in this old one. So let's keep going down. Sound is good. Thank you, Gil. See what we can learn from looking at this. We're not obviously going to go through every page because a lot of these are very detailed and specific to the product sold at that time, but we'll try and highlight anything that stands out. So we've got a $750,000 initial death benefit. This is not a blended design. Now, Penn Mutual, if you've seen my IUL comparison spreadsheet video, I'll link that up here later on so you can get direct access to it. But otherwise, just do a search on my channel and you can see the IUL comparison spreadsheet. I go over the Penn Mutual IUL in a little bit of detail in that one. And one of the things that we notice, and this is easy for agents to miss, is there is the ability to do a blended design, but the benefits of it are not immediately apparent. If you just try and do a blended design, hey, Joe, yeah, this was started in 2018. If you try and do a blended design on a Penn Mutual IUL, you're going to see lower cash value in the first year than if you don't do a blended design. And that might make you think, why would you want to do a blended design? It's better for the client and it's better for the agent if you don't do a blended design because the agent makes more commission and the client has more cash value in year one. The month right here, May 28th, 2018. So That's what you might think if you were to just look at the initial years of a comparison illustration with a pen mutual IUL between a blended design and a non-blended design. The agent will make significantly less money if you do a blended design, and it looks like the client has less cash value out of the gate. I mean, they do have less cash value out of the gate. But when you go 20 and 30 years down the road, the client actually has quite a bit more money. And in one of the cases I was looking at, it was over $100,000 more by the time you get to, 30 years down the road. So it could end up being a significant difference by doing a blended design, but it's not automatically apparent that there's a benefit to that. So this agent did not do a blended design. I don't know if they knew that they had the option. They may not have had the option to in 2018, of course. But even if they did, it's possible that the illustration still did the same thing where it didn't show an apparent benefit to the client to do a blended design. So that's something to keep in mind. I'm not going to give this agent a pass or a fail on this design because of that. Because I don't know in 2018, I wasn't selling this product in 2018. I don't know what the blended design could do. Okay. Or if it was even available. It may not have been available at that time. But good to know that it's starting out $750,000. You can see the initial premium, $2,084. Now, I believe the client ended up funding this at $30,000 a year. So the MEC limit was set slightly higher than this, and they increased their contributions, which is partly why I think we're probably outperforming the illustration. Anytime you can max fund your policy, you're giving it the best opportunity to get growth. The underlying costs are going to be essentially the same. And when you put extra dollars in there, for the most part, the only extra cost that's incurred is the load fee that comes off of that payment. Everything else turns into cash value and has the opportunity to grow based on the indexes. So it behooves you, if you want to make the best use of these policies, to max fund them. That's the case for nearly every IUL. If you're not max funding it, you're not giving it the best opportunities to succeed. So we can see the current cap was at 4%. There is a minimum current cap is 11%. There is a minimum of 4%. Okay. Current cap rate is now 9%. Now, if your index options are S&P options only, the cap rate is going to make a big difference in what your overall growth could potentially look like. The S&P tends to have a negative or a zero return year once every 4 years or so. So if your cap is 11%, and let's say that you get a 1-0 year and it caps out the other 3 years. Now we're at 33% over the course of 4 years. That's an average of 8%. But when your cap is 9%, now you're going to get 27% over the next 4 years, which puts you at just under 7% return on average. And that means it has to cap out in those other 3 years. That doesn't necessarily happen either. Although a lot of times the S&P either is negative or it hits a cap. It hits the cap. That does tend to be the case, but it doesn't always hit the cap. And so you're not necessarily going to be getting that 7% average or just under 7% average. It could significantly impact it if you end up with some years that fall below the cap more than just the 0 year once every 4 years. Did the client pay the annual premium or monthly since May 2018? Monthly. I believe this illustration, the premium mode is monthly, and that is how they were funding it. Okay, and in this 1 year segment, there was a cap of 9.25. The uncapped, there's a spread of 6%. This one currently has a spread of 3%. So the spread got a little bit better. They don't offer this one in the current IULs. I'm not sure what the rates are currently for those, or if they're still even offering it for these. One of the nice things that Penn has in their IULs, this 12-month dollar cost averaging account. Most of your IULs have a point-to-point, and oftentimes you have the ability to have 12 point-to-points throughout the year. So if you make monthly payments, you end up with 12 point-to-points. Not all of them. Allianz does not have that. Allianz just has one annual point-to-point, but they give you the option to lock in throughout the year. So the way I look at the Allianz one is your dollar cost averaging annually. With these other ones, you have the opportunity to dollar cost average monthly. Dollar cost average monthly is my preference, but none of these other products tend to make up for all of the other things. So the Allianz one, it's still worth it to dollar cost average annually, in my opinion, for that one. But what Penn offers with their dollar cost averaging account is the money that sits in there, and this is what makes them unique. The money that sits in that dollar cost average account, they're giving you a 10% interest rate until it gets into the indexes, until it gets applied to the indexes. Now, that's not a huge dollar amount difference. It's actually pretty small, but it sounds good. And it's better than the alternative that we get from like National Life. With National Life, you can do a dollar cost averaging, and you're going to get like 2% on the money that sits in the fixed account until it gets put in to the dollar cost monthly point-to-points. So 10% or 2%. Obviously, the 10% sounds really good. Now, if you're putting in $10,000, or let's say $12,000 over the course of the year, that's $1,000 a month. You're going to have $11,000 that is not in there for that first month, and it's going to earn the equivalent of 1 month's worth of a 10% annual growth. Well, an annual growth at what's 10? Let's go 10%. Divided by 12. So it's 0.83%. You're going to earn 0.83% on $11,000 in that first month. That is $91. So you're going to earn $91 for that first month before it takes another $1,000 and gets it into your account. And then the next month it's going to be $10,000. So that'll be $83 that you're going to earn the next month on those funds that are just sitting and waiting to dollar cost average. It's not a huge difference, but it's something, and it's nice. It's nice to have. So it's just one of the neat features that they offer. But just know it's not going to make a huge difference in your account. It's not something that I would necessarily use as a determining factor when deciding which product to get. But chalk one up for the Penn Mutual team for having that option there, because it is kind of nice. Yeah, and that's that holding account. What else can we see here? Index credit enhancement of 10% will be paid on each segment maturity date after the initial policy date across all index accounts. An index credit enhancement. That's not something they have on their current policies. We also have a policy value enhancement. So after year 10, this is also known as a persistency bonus. They're going to give a 0.3% persistency bonus annually if you keep your policy after 10 years. It looks like they credit it monthly at this rate, 0.025%. Now, Some other carriers offer something similar, and it's generally 0.25% is what I've seen. So this is slightly higher than that. Not too bad. Certainly better than not getting anything. Then we have the index credit enhancement. So I wonder what that is. I haven't seen that in any of the current products. It's based on the index performance. So if you get a 5% return, they're going to give you a 5.5% overall credit. That's what that looks like. So that's pretty good. That's just like getting a bonus. Penn Mutual doesn't offer a bonus currently. This is essentially a bonus. So maybe it had something to do with the rules at the time that they had this feature. And in this product, it's guaranteed that it'll be at least 10%. So it doesn't look like they reserve the ability to get rid of that. So that's kind of nice. They use an increasing death benefit. We like to see that. Now, at the time that this policy was started, mech limits were lower. So the same amount of death benefit today, $750,000, you might be able to put in twice as much as what you could have put in if you started a policy back in 2018. From an IUL perspective, that just means these days we can carry less death benefit and put in more money. Helps from a cash growth perspective. And an underlying cost. I mean, obviously we have a little more streamlined costs in this case. So there's our benefit riders. There's the class. Again, there's the detail of the allocations. So their current Penn has adjustable loan rates. In 2018, that rate was 4.2%. The current rate is 5.7%. And it looks like their wash loan, in this instance, you get a net 1% cost for the first 10 years, and then it will wash after that. In years 11 and beyond, the current credited interest rate is the adjustable loan rate. The credited rate subject to change, but never to be less than 1% or less than the adjustable loan rate minus 0.25%. So it looks like that's their current credit rate, but they do reserve the ability to have it not quite wash by 0.25%. 0.25%, not a big deal in the scheme of things, but something to be aware of. Most of your new Penn policies it's a guaranteed wash after 10 years. Let's see. So they have an index loan that has a separate account than your normal index. So if you're doing a participating index loan, in this case, it gets moved into an account with a cap of 10%. So this is 1% lower than if you weren't doing a loan at all. So that's interesting. I generally don't care for specified indexed loan accounts that offer limited choices and obviously reduced offerings compared to what you get outside of the loaned account. But it is what it is. If you're not going to be borrowing much out of your policy, it's not that big of a deal. At least in the early years. So this one, their MEC limit, you can see is $28,545. That's the guideline annual premium. Now, this doesn't tell us what the 7-pay MEC number is, but the 7-pay MEC number was higher than this number, and which was why I think this client was able to put in 30,000. Oh wait, here we go. There it is. Yeah, the client is able to put in 30,000 for the first few years, and then it'll likely reduce, so that by year 5, it can't be any greater than the guideline, which is 28,545. So that's the long-term MEC limit in the policy. This is the initial, what you can put in if you wanted to, but it will adjust. All right, what else can we glean from this? Let's see if we can get to the numbers, huh? Almost there. Boy, 46 pages in, we finally get to see some numbers. All right. So you can see age 42. These are going to be end of year values. Cash surrender value in year 1. If he put in 25, which we know he ended up putting in more than that, but if he put in 25, he would have just over a third of that available. This is normal for a pen policy. Okay. You got a decent amount of surrender charges. So about 9,000, 10,000 in surrender charges that first year. 9,000 the second year, 8,000 the third year. So it's going to slowly reduce. Those charges go away by year 10. Right here, you can see that. Go away by year 10. Now, we are in year 5. We're in year 5. Let me see. Okay, so he didn't give me the current values when he sent this in, but he did say that it's doing better than illustrated. He was just worried about the cap reductions. So there's definitely some concern about cap reductions. I would keep an eye on that. If for some reason the cap reductions cause you to start underperforming the illustration, underperforming other things that you could potentially be investing in, maybe compare it to other products that there could be, you could do a 1035 exchange, move into a new product. But there's going to be a lot of things to consider, especially what is the impact on your cash value in the early years. You're going to get a new surrender charge period. How will that affect your access to the cash, and do you need that? Joe's question: did the client pay 25 every year or a different amount? No, he paid more than the 25. In fact, I think he put in 30,000, but he paid in at least the 25 in each of those years, at least what it would let him. So if he put in 30, I believe he put in 30 for a few years, it's possible it would have forced him to go down a little bit more. But essentially, I think he gave himself a good opportunity to beat the illustration by putting in some extra funds. You wanted to compare his returns if he invested elsewhere. Oh, gotcha. Yeah, I don't know. I just know he put in 30 for at least a few years. So I would just, I don't have his numbers either. I don't know what his actual numbers are. If I recall, I did meet with him. I'm thinking his actual policy values were around 118 as opposed to 112 that we see here, but he did fund it at a higher level. think that's the case. I can't remember. My apologies. I should have double checked this, but I've been sick all last week. I should have double checked our meeting before this one. I'm still recovering a little bit. You can hear my sniffles, but we're at the tail end of this. So in general, I don't worry too much about whether you could have done better elsewhere. That can be the case with any investment. You can always look back and think, oh, you could have done better than this by doing this over here. Well, at the time, you have a decision to make. Okay. And every day you've got decisions to make. Do you want to invest everything you have in investment A, or is it appropriate to spread it out and maybe do some investment A, some investment B, some in investment C in order to diversify? And of those investments, which ones are aggressive? Which ones provide a more safety in their growth aspect or downside protection? A lot of your investments, in fact, every investment out there outside of life insurance has no downside protection. Well, I guess you could say bonds have a downside protection because you could just hold them. You know what they're going to do, right? So bonds are a good alternative to just being all invested in equities, right? Well, I like life insurance as a good bond alternative. It doesn't mean you have to invest everything in life insurance instead of bonds. There could be a balance there that will better meet your needs. In the case of IUL and whole life, you get good growth potential, potentially better than what you could be getting in bonds, along with other benefits, and that's after expenses. But you could have better growth potential and a similar downside protection. There's a lot of good opportunity. Does that mean that I think you should invest everything in your life insurance? No, I don't think so. One, we don't typically refer to these as investments, so we don't really like to compare these to other investments. They function a little bit differently. The reasons you're going to get them are going to be a little bit different. Now, the advantage of this is you don't have to necessarily choose one or the other, even with the same dollars. You could put your money into here, and if you need to access it, you can. And you don't have to worry about a margin call. Like if you have investments, we talk about infinite bank all the time, where you're creating a bank. You're creating a line of credit right here that you have access to throughout the rest of your life. Okay? The cash values in your life insurance policies is available to you for the rest of your life at whatever percentage is guaranteed by the contract. You can access it by not impacting the growth. You can access it by impacting the growth but getting a guaranteed return. There are a lot of different things that you can do that make these a very good tool for building up a line of credit that you can access later in life. Now, you may not need to access it, and we get decent growth out of it. We could even get outstanding growth. There is the potential to get outstanding growth. But I'm not going to say do this or that when it comes to investing in this or investing in the stock market. There's not really a reason to do that. Okay, I think there's a place in our portfolios where we can look at both as an option. And what is the proper balance in order to meet current needs, future needs, risk tolerances. Now there's some scenarios where somebody has come to me and they've been investing in the stock market and had great success and they've got millions of dollars. And they're at a point where it's like they have no interest in reducing the risk tolerance or the risk in their portfolio that they have in the market. And they're happy with the amount of money that they have in there. They have no need to be borrowing against it. And so it wasn't appropriate for them to do anything with a life insurance product. That was their determination. And I agreed with it based on our conversation. So everybody's going to be different. You've got to figure out what's going to be best for your situation, what's going to help you best meet your needs. Now, for my situation, I have quite a bit invested in my life insurance products because of the safety and the liquidity that it offers, as well as the other benefits that go along with it. The death benefit, having some good growth guarantees, that downside protection. That works out really good for me because I like to play around in the stock market, but I really don't like to lose money. So the safety and the growth that I get from my insurance policies allows me the flexibility to be a little more aggressive in those other areas. Play around a little bit. I'm not going to lose everything. Even if I do terribly in there, it's not going to cost me everything because it's just a small portion of my portfolio that I play around with there. Right. And it's the safety aspect here that affords me the ability to do that. So that's how I like to look at it. I think it's a false dichotomy to try and say that you have to do one or the other, or you shouldn't do this because you should do that. I think there's probably a proper balance that we can find there. So this one's not too bad. The break even, it looks like the break even is a little longer than we would like to see. Looks like right around year 8 where we break even, potentially. That's if it matches the illustration. Now this is outperformed, but in 2018 through 2021, the market did good. The S&P did good. I think maybe 2018 was not ideal, but the other 3 years were real good returns. So not surprising that he's outperforming here. We'll see if that can continue. But overall, this can be a decent product. I didn't have any issues with it. He doesn't have any issues with it other than keep an eye on that reducing cap rate. Make sure that the ability for you to get gains still matches what your hopes and your desires are out of that product. And if something changes, if for some reason they reduce your ability to get good gains in this, or at least gains enough that you're happy with it, you might consider doing a 1035 exchange, move those into a different product. You can 1035 exchange from life insurance to life insurance or life insurance to an annuity. You've got different choices there that are available to you depending on what your needs are. And that's without incurring any type of tax consequences. So it all happens behind the scenes, similar to a 1031 exchange with real estate, except there's a little more restrictions around a 1031 in real estate that can make those ones a challenge to do. These ones, you just need to have a positive cash value that you're moving over. And the basis will move over to the new one as well as that cash value. I think that's about all we're going to get from this. Yes, we're at the end. So if you have any questions, put them in the comment now. Otherwise, we will wrap this up and we will be back again next week. Now I'm heading out to Allianz. I might have some things to report next Tuesday with regard to whatever they're presenting. I think it's a leadership conference. I'm one of the top Allianz salespeople across the country for the last 2 years. So they're recognizing me for that. And I do find I do tend to find out some good information from them, and I get a chance to talk to their not auditors. I get a chance to talk to their actuaries and the people that are doing the investments in the options, things like that. So it's pretty cool. Yes, this one is beating the illustration. I don't remember the exact number. I did meet with this client for this one, but in his initial email to me, he stated that this policy is doing better than illustrated. His main concern was the cap reductions were worrying. So it is beating it. I don't know by how much. He didn't give that in this email. We probably talked about it when we met, but I've been sick. I forget it. Beat the illustration because he funded it more. Yeah, I'm sure. I'm sure that has a chance. It has something to do with it because you get a better opportunity when you put more money into it. But no, I think as a percentage, I think he was probably on par with this illustration also. Good. That was a good question. Because did he just throw a bunch of extra money into it so the cash value is higher, but the return is way lower, but the number shows up higher. Yeah, that's not the case that's happening. So he was happy with the performance of this in relation to the illustrated amount. So, and at the end of the day, that's the most important thing. Are you happy with the product that you own? Are you happy with how it's growing? Now, in my mind, if we're anywhere close to the performance of the illustration, that's a win. I think that's good. If we're beating it, even better. If we're slightly under it, not that big of a deal because we have no idea what the index is going to do year to year. So if on average it's holding near that, I think we're going to be pretty happy. I know I would be with my products. My expectation is to beat the illustrations that we do because we dial the illustrations back, and the average return in the indexes that we use are quite a bit higher than what we're illustrating. So if we can get and almost by double, so like I like the 40% bonus option in the Allianz index, and with that 40% bonus option, the average over the last 15 years would have been around 13%. Figure close to 12% after the asset charge. And I'm illustrating 6% returns on these things. So it would have to underperform by half of what it has been in order to basically get to the illustrated amount. So my expectation is that we can beat these illustrations. Whether we will or not, who knows? It's all going to depend on how the indexes perform in the future. And we just don't know what they're going to do. But if they perform anywhere close to the average that they have been, we're going to be really happy. So, and even if they perform at a lot lower than what they have been, we could still be really happy. So, all right. I appreciate you guys joining me. Thank you. We will be back again, not Thursday. We're going to be back again next Tuesday for another IUL. And come next Tuesday, AG 49B is going to be in effect. So we'll probably take a look at some illustrations. I will have some information as to how some illustrations have changed. The actual performance of any products won't change due to AG 49B, but the illustrated, what's allowed to be illustrated, will change. So thanks, Joe. Appreciate that. Appreciate you engaging and asking questions. I always like that. So if you guys ever have any questions, feel free to put them in the comment section, and I will do my best to answer those every time. Thanks, and we will see you next week. Have a good one.